In fact, more than there was when the financial crisis hit. And while Western nations still try to get a grip 7 years later, it's emerging nations and corporations that could trigger the next banking crisis. Also this week, the oil curse strikes again. Can Nigeria get a grip on crude corruption under its new president? And tearing down trade barriers to create the world's biggest economic trading bloc. But the Trans-Pacific Partnership has a flip side. We look at the effects on farming and manufacturing in Latin America. Hello everyone, we're taking one of our big picture looks this week on Counting the Cost, and an important picture it is too. Debt. The trigger for the financial crisis. Households mortgaged up to the eyeballs, unable to repay their debts. And let's not forget the banks and the institutions which made it all possible. What followed from the collapse of Lehman Brothers to the Greek debt crisis, it all suggested the world would no longer fall foul of debt. You would think our addiction to debt would encourage some sort of, detox. No chance. Rather than falling, debt has actually increased by $57 trillion to $199 trillion, according to the McKinsey Global Institute. That number is a staggering 287% of global GDP. But would you believe there's a bigger issue, and it's actually in the emerging economies, where companies have increased their dollar-denominated debt to $18 trillion by last year, and look at it in 2004, it was only $4 trillion. That's what the IMF says. And so with companies setting aside more money to pay the interest on their loans, that means less money going into the economy. And now take a look at these nations here. We've got Brazil, China, India, South Africa, Turkey. Those numbers there from 2007 is a total debt as a percentage of GDP. It's very much manageable at that point. But here it is by the end of 2014, and all of those countries, as you can see, have been sucked into fueling their economies with credit. So it is a bad picture, and nothing illustrates the accumulation of debt better than the Brazilian oil industry giant Petrobras. Because remember, this is about companies as well as economies. Petrobras has $125 billion worth of debt, and as the dollar strengthens and oil prices slump, paying its loans has become even harder. Virginia Lopez takes us through the Petrobras story.
Petrobras, once the motor behind Brazil's spectacular transformation into global superpower, has been hit hard by the sharp decline in oil prices, the slowdown of China's economy, and a corruption scandal of epic proportions. As if to add insult to injury, Petrobras must now meet a series of upcoming bond payments with funds at critical levels.
It's my view that they will not have so many difficulties that they're unable to meet their debt obligations. I think that the company does have a number of funding mechanisms that are still available to them, whether they come directly from the government, indirectly from the government, or even from the capital markets.
But it won't be easy. What was once the jewel in the crown has also been recently downgraded to junk status. And its market value, once higher than Microsoft, is now only a little over $40 billion, $400 billion less than at its peak. An inability to access markets as oil prices hit record lows means that the investment needed to increase production can no longer be made.
The price of oil, that's something that has already impacted Petrobras and the investments of Petrobras. Petrobras is the biggest company in Brazil, so if you have a lower oil prices, it impacts on investment and of course in the growth of Brazil.
With an inflation hovering above 9%, a recent devaluation of its currency, and more than 7% of unemployment rate, all the elements seem to have collided into the perfect storm for Petrobras and for Brazil itself.
Petrobras is having an unprecedented combination of negative factors and headwinds against it. I do think, as I mentioned earlier, that the company will survive. It's not my base case that they're going to default on their debt, for example, or that they will be unable to continue funding themselves.
But the pain of Petrobras' decline is felt across Brazil. Less than a decade ago, Petrobras was ranked as the world's 6th largest company. Today, the oil giant is number 416. Many of its ambitious infrastructure projects lie abandoned, and Brazilians' hope for a brighter future has all but extinguished. To many, it's unlikely that Brazil will let Petrobras go under, but a deeper devaluation than expected and a further drop in oil prices means that the perfect storm is still brewing.
So Brazil there, just one example of a country struggling with inflation, unemployment and debt. We're going to tie the global picture together this week with Susan Lund in Washington, D.C. She is the Director of Research at the McKinsey Global Institute. And you know, Susan, we had a financial crisis about, I don't know, 7 or 8 years ago, you might remember that. And it was so big. We had a Greek crisis after that. We had a Eurozone crisis, all these things that happened off the back. And here we are all these years down the track, and there is more debt in the world than there was then. Help me out with this one. Is this just how the financial system works, or is something wrong here?
Well, the world does appear to be addicted to debt. Total global debt has increased by $57 trillion since 2008. Now, of course, the people that got into trouble back in 2008 have indeed reduced debt. So U.S. households, for instance, have reduced their debt quite substantially. And so have households in Ireland, Spain, the United Kingdom, and a few other countries in the world. But the countries that were not at the heart of the crisis have continued to borrow. So this would include governments, as you pointed out, in Europe, in Japan, in the United States, households across Northern Europe and even in emerging markets, and borrowing in China has quadrupled.
So is it that they've had to do that, or is it an option they've taken? I'm just trying to sort of break this down for our viewers so we can understand why those governments and why those parts of the world have gone into more debt.
Well, I think it differs. Governments, you could say, had to borrow to some extent because during the recession that followed 2008, they saw tax receipts go down and demands for fiscal stimulus and financial sector bailouts increase. So governments were short of cash. They went on a borrowing binge. And collectively, governments have borrowed $25 trillion. Households and companies, though, are a different story. There, I think it's just the temptation of easy credit. So if you can borrow and buy a house or a car or take a vacation and pay for it later, why not? So as long as there are banks that are willing to lend, then of course people like to consume now and pay later.
Yes, but I mean, okay, so credit, you've brought that up there and I'm glad you have, because again, it's hard to understand the theory. Here we are this many years after a financial crisis that was caused by easy credit, by the subprime mortgages in the United States. And that easy credit, as you've said, is still there. It's not making sense.
Well, it's interesting. So there are a couple different factors at play. Let's take a look at China. So China has been growing at 10% every year for the last 20 years. A lot of that was driven by investment. The Chinese households also save a tremendous amount. Somewhere around 30% of their income goes directly into bank deposits. So banks have a lot of liquidity, and they have gone on a lending spree. They have lent to households, they've lent to Chinese companies, they've lent to government entities to build infrastructure. So a big part of the increase in global debt story is actually China. It alone accounts for almost half of the increase in debt globally since 2008. And that's because they've got a lot of savings and banks need something to do with that money. In other countries like emerging markets, it's a different story. There, a lot of it is institutional investors, so pension funds, mutual funds, who had been investing in things like European government bonds or U.S. treasuries. Well, as you know, interest rates, U.S. treasuries are at historic all-time lows. You don't earn very much money. And so they've gone to emerging market governments and companies who have been issuing bonds to get a little bit higher return. So there, it's really global investors looking, we say it's the search for yield that's driven them into emerging market debt.
And don't we therefore have a bit of a ticking time bomb on our hands with those emerging markets? Because when the Fed eventually does raise rates, and we do expect that to happen, and we'll find all that hot money, as they call it, is going to leave those emerging markets.
That is indeed a big fear. And already we've seen that starting to happen. So a year ago, or a year and a half ago now, when the Federal Reserve even talked about starting to taper asset purchases, we had what we called the taper tantrum and a lot of money poured out of emerging markets. It's since returned, but now over the last 3 months, once again, you see institutional investors starting to pull out of emerging market bonds in anticipation that U.S. Treasury yields are going to head higher. Now, so far, the Federal Reserve has not increased interest rates. And indeed, in September, by not raising the short-term rate, I think it signaled that it's going to be very cautious and take into account global conditions as it pursues higher interest rates over the next several years.
Susan, can I ask you one more thing about China? You did mention it before, but there's some other stuff I want to address, because we've had various guests on this show who I've spoken to who have given us the different ends of the spectrum as far as Chinese debts go. Some say we should worry about Chinese debt, and others would tell us that it doesn't matter because Beijing will probably write it off anyway and there's nothing to be worried about. How seriously do you view the Chinese debt threat, as it were?
Well, I think that China's debt is not a threat to the global financial system. It's not going to have the worldwide direct impact that you saw from the financial crisis in 2008. And that's because most of the lending is done by Chinese banks and what we call shadow banks, sort of non-bank lenders. So it's going to be mainly a domestic bank problem for them. And it's true that the central government has a lot of capacity. It has foreign reserve assets. It could issue its own debt to bail out the financial sector if it needed to. But I think the big worry is that growth in China will slow even further. So what happens is, even without a financial crisis, when you think about a credit boom, GDP growth is higher than it would have been during the years that you're borrowing, because you're borrowing a lot, you're spending money that you don't really have, and so GDP growth is artificially inflated. Well, when that comes to an end, you can't keep lending and borrowing forever. So in China's case, even the slowing growth of credit is actually going to hit GDP. So suddenly you actually are growing more at the long-term rate that you used to, and that feels like a recession. China's growth rate is already slowing for other reasons, partly because of an aging population and so on. And so I think the rest of the world is going to feel China's debt crisis mainly through the fact that GDP growth could slow quite significantly. And as the world's second largest economy, that's going to have implications for everyone.
That is Susan Lund explaining the debt conundrum to us here on Counting the Cost. Susan, we thank you for your time.
Thank you.
And still ahead on Counting the Cost, the TPP, Trans-Pacific Trade, gets a big boost. But at what cost to regional trade? We'll look at Latin America a little later on. Right now, though, Nigeria, a country which, under a new president, is trying to finally do something about corruption. And that means, for President Muhammadu Buhari, going after the biggest export earner, oil. Now, for starters, he appointed himself the oil minister. And in recent days, there were reports that the former oil minister, Dezani Alison Madueke, was arrested in London. Under her stewardship, it's alleged by the country's former central banker that $20 billion went missing from the state-owned oil company. More staggering, up to $400 billion was stolen from the country's oil coffers between 1960 and 1999, according to the World Bank. Which shows us, doesn't it, that the importance of oil cannot be overstated. It accounts for 80% of the government's revenue. And the fact that money hasn't been spent to improve the lives of Nigerians has been blamed for the rise of militants in the oil-rich Niger Delta, and even goes some way to explain the rise of Boko Haram in the north as well. So Nigeria's got some work to do, but there's a new breed of younger entrepreneur and business person coming through trying to make that happen. Like our next guest, joining us from London this week, Dr. Amy Jedasimi. She's the managing director of the Nigerian oil services group, Ladol. There is a lot we can talk about, Amy, but I want to start with something topical, and that is the fact that, as we mentioned, Nigeria's President Buhari appointed himself as the oil minister. What did you make of a decision like that? How do you think it will, or rather, do you think it will have a positive effect?
Hi, thank you for having me. It's already had a positive impact. It wasn't a surprise because we've been hearing rumors of this almost since he won the election. And the reason for that is that when he was previously in government, he also handled the oil portfolio. Since the official announcement that he's going to be Minister of Petroleum, we've seen a very positive reaction from the international community and even more positive reaction from Nigerians, because we know that tackling the oil curse, which Nigeria seems to be suffering from or has suffered from, is a #1 priority. And we have confidence in the president, and it's part of the reason we elected him, that he's the guy to sort this out.
Okay, the oil curse. I'm glad you said that because we used it as well earlier in the program. It's an interesting one. Why don't you briefly explain what that means to our viewers?
So what it means is that you have a developing economy like Nigeria, which in the 50s and 60s had a thriving agricultural sector. I think we were the largest exporter of palm oil. We discover oil, and all of a sudden we go to a situation where we have high unemployment, particularly in the youth. Our agricultural sector goes into decline. Now we're importing our rice, and we're importing a lot of our other agricultural products. And that has happened because we haven't been taking advantage of, I think it must be something like $800 billion that we've earned from oil since we started exploration and production. We haven't been investing in industry, local content. That is the amount of work that actually gets done in Nigeria when we carry out exploration and production is about 10%. We're spending about $18 billion a year on oil and gas. So if local content is at 10%, that means only $1.8 billion is being spent in Nigeria. At the same time, if you look downstream, our refineries haven't been operational, which means even though we're one of the world's largest oil and gas producers, we're actually importing petroleum products. If you look on the gas side, we haven't yet managed to